Welcome back to this deep dive. Today, we are taking a scalpel to the United States Antimony Corporation. That's UAMY, and their third quarter 2025 earnings call.
Right.
And for anyone tracking the critical mineral space, this one is essential. UAMY really represents this fundamental tension.
Yeah, that absolutely does.
A company with massive strategic wins, a market cap over $1 billion, but at the same time, they just delivered short-term financials that really disappointed the street.
That tension is the whole story here. I mean, you've got UAMY transitioning from, a speculative microcap into what is essentially a genuine national security asset.
Mm-hmm.
And this quarter was maybe the most crucial inflection point in that journey. But as we see so often in these big industrial ramp-ups, the execution risk, it showed up immediately.
So management is pointing way down the road, but
Right.
the bumps are right here.
Exactly. They're guiding to a massive long-term payout, but the cost of getting there is being felt right now.
Okay, so let's unpack this. Let's start with the cold, hard numbers, because it was a clear miss.
No question.
GAAP EPS came in at -4 cents. And consensus, it was sitting comfortably in positive territory, plus 1 or 2 cents.
Yeah, that's a big swing.
And the revenue line, that was maybe the bigger shock. UAMY posted $8.7 million. The street was looking for what, 12.9?
12.9 million, yeah. That's a 33% miss on the top line.
Ouch.
And when you see a 33% miss, the market reacts instantly. We saw that caution. And this is despite the massive strategic backlog they've built up.
But there's context here.
There is. You have to add context. That 8.7 million, disappointing as it was, it's still a 238% increase year over year.
From Q3 2024.
Right. They are growing fast.
Yeah.
The issue is just that they missed the accelerating growth curve that analysts were baking in.
And that caution was cemented when they narrowed their full year 2025 revenue outlook.
Yeah, they brought it down to 40 to 43 million, which is below that prior consensus of 46.4. It's a classic high growth problem,
The trajectory is still up, but the immediate momentum just isn't what people were betting on.
Precisely. And that leads us right into profitability. Because how does a company with that kind of year-over-year growth end up with a net loss?
Right. The company reported a net loss of $4.78 million for the quarter. And that number, it immediately raises a red flag, especially for a new billion-dollar company. What was management's explanation?
Well, they immediately redirected the focus. They stressed that the loss was heavily weighted by non-cash charges.
Okay.
Specifically $5.18 million in non-cash expenses. And the biggest piece of that, by far, was $4.69 million in stock-based compensation for the execs.
Which is common in this space.
It is. In national security, critical minerals, these are incredibly capital-intensive industries. Management often uses equity to preserve cash for the build-out. They're basically saying, we're keeping the cash to fund the smelter, and we only get paid if the stock goes up long-term.
It aligns interests.
It's a necessary tactic when you're scaling this fast.
So the balance sheet supports that. They ended Q3, very well funded, $38.5 million in cash and federal securities.
Yeah, and they were, maniacally focused on fundraising. They raised about $43 million year to date from warrants and equity.
And then another $66 million in October.
Right, and that money is not just sitting there. $16 million year to date has gone straight into CapEx for mineral rights, and really the centerpiece of their strategy, the Thompson Falls smelter expansion.
And we're already starting to see that pay off a little bit.
We are. There's operational momentum that kind of bucks the Q3 trend. Gross margin for the quarter was 23%, fine. But management highlighted October sales, which clocked in at $5.6 million.
Which is way up from the Q3 average.
Way up. The Q3 monthly average was about $2.9 million. So you're already seeing that sequential acceleration kicking in right now.
And that brings us to the linchpin of this whole thing, Thompson Falls. This facility, right now, produces about 100 tons per month of finished product.
Just 100 tons, yeah.
Management confirmed the expansion is 65% complete. And the expectation is for capacity to soar to 500 or 600 tons per month by early 2026.
And that's not just an increase, it's a 5 to 6-fold jump. If they hit that volume, and look, that is a massive if, it changes the entire economics of the company.
Huge operating leverage.
Absolutely. You're spreading all those fixed costs over a much larger product base. The credibility of their entire 2026 guidance, it all rests on hitting those volume targets.
And that guidance is ambitious. They're holding firm to that $125 million revenue goal for 2026.
They are.
Even after cutting the 2025 outlook. So given the miss this quarter, what gives them the confidence?
They point to one thing: the massive secured contract backlog. They've executed 2 new 5-year contracts totaling up to $352 million.
That's a monumental number.
It is. I mean, to put it in perspective, management noted this new backlog just. It absolutely dwarfs the total $15 million in revenues the company had last year. It gives them revenue visibility they've never had before.
Okay, that is a genuine game changer. Let's break down those 2 contracts.
First up is the national security piece. The $245 million sole source IDIQ contract with the U.S. Defense Logistics Agency, the DLA.
And IDIQ, just to remind everyone, that's indefinite delivery, indefinite quantity.
Exactly. It's a critical point. It means the government is committing to UAMY long-term as the main domestic supplier. They'll order what they need when they need it. The relationship is secure.
And this is for the metallic antimony ingots.
Right. The stuff used for hardening ammunition, sensors for night vision, really critical applications. And they expect initial orders from the DLA totaling $60 million within the next 6 to 8 months.
Okay, and the second contract.
Yeah.
That stabilizes the industrial side.
It does. That one is valued up to $106.7 million. It's with a major domestic industrial customer.
And this is for antimony trioxide.
The white powder, yeah. It's a key component in fire retardants, and it's also increasingly important for high-grade solar glass. So serving both markets shows this crucial versatility.
Okay, so securing the buyers is one thing, but feeding a smelter that's about to increase its appetite 6 times over, that's the hard part. How are they tackling the feedstock problem?
This is where the execution risk is highest, no doubt. They've laid out this comprehensive but logistically very complicated strategy.
Right.
To guarantee supply, they've signed over 15 third-party supply contracts across 10 different countries. They are actively diversifying away from any single source.
And Bolivia is a big piece of that.
A huge piece. Bolivia is expected to deliver 150 tons per month of antimony metal starting in the first quarter of 2026.
Which lines up perfectly with the Thompson Falls ramp.
Exactly. The timing is critical.
And maybe most importantly, they're finally starting to bring their own domestic supply online. The vertical integration dream.
That is a long-term solution. UAMY has started mining a bulk sample at Stibnite Hill in Montana. They've trucked about 560 tons so far.
And this isn't just about volume, it's about margins.
That's the whole point. The long-term goal is to displace all that globally imported feedstock with their own higher-grade domestic supply. And management projects this vertical integration will ultimately boost their gross margins to over 60%.
60% plus gross margins. That's a massive financial pivot. Why does using their own supply generate such a huge margin jump?
Well, look, when you're sourcing globally, you're paying heavy logistics costs. Shipping from 10 countries, handling import duties, you name it.
And you're often paying for lower grade ore.
Exactly. Which means you spend more energy and time smelting waste material. The domestic Stibnite Hill resource is projected to be much higher grade. So that immediately cuts transport costs and it increases the yield per ton you process.
You remove the middleman.
You remove the middleman and the shipping costs and it flips the economics entirely.
So beyond antimony, they're not sitting still. They're actively pursuing a diversification strategy.
They are. They're targeting other minerals critical to national security. Tungsten at the Fostung deposit and cobalt at Iron Mask, both are in Ontario, Canada.
And the blueprint is the same as antimony.
It's identical. Secure the resource, secure the processing, and lock in long-term contracts under that critical mineral umbrella. They want to be a one-stop shop for North American critical mineral independence.
So what's the immediate catalyst that could unlock the tungsten valuation?
That would be the SK 1300 compliant resource report for Fostung. It's scheduled for mid-January.
And the SK 1300, that's basically the gold standard for validating a mineral resource claim.
It is. A favorable report isn't just good news. It's the document you need to unlock government funding, to secure partnerships, to get institutional investment. It proves the resource is viable and bankable.
This level of ambition is staggering for a company that was a microcap so recently. We have to mention the M&A activity.
The Larvado Resources bid?
They threw down an indicative $722 million offer for them, which was rejected.
But that rejected bid is essential context. It shows management's absolute confidence and their massive appetite for global scale. They are not content to be a small domestic player.
And they're still the largest shareholder in Larvado.
They are, with 10%. It shows they're willing to deploy capital on a massive scale to secure that supply chain. It's something investors often overlook when they just focus on the revenue miss.
All right, now we have to address the elephant.
Yeah.
Or maybe the 10,000-pound gorilla in the room. China.
You have to. This geopolitical reality underpins every single contract and every dollar they're spending.
Management really hammered this home.
They did. They drove home the point that antimony is vital for U.S. defense. And they presented the dependency starkly. China dominates global production 60-1.
60-1.
And they control 85 to 90% of global refining capacity. It's not a risk. It's a structural vulnerability for the U.S. The company pointed out that our strategic reserves are, and I quote, absurdly low. Weeks, maybe a couple of months of supply.
So when the U.S. government, through the DLA, signs a $245 million contract, they're not just buying product, they're subsidizing the creation of an independent supply chain.
That's exactly what they're doing. That is the premium the market is trying to price in. That geopolitical de-risking is the core thesis.
And that's why some analysts are holding firm.
It is. It's why analysts like H.C. Wainwright maintained a high price target, $10.25, even though the stock dropped 5 to 7% after the call. The market saw execution risk. The analysts saw a temporary blip on a necessary national defense build-out.
Okay, before we wrap up, it's time for our segment. This is not financial advice.
My favorite part.
This is where we pitch an outrageous but plausible trade idea based on everything we just discussed.
All right. The thesis here is that the market is way too focused on the Q3 disappointment and that slight 2025 guide cut.
It's being short-sighted.
Totally. The massive $352 billion backlog, the billion-dollar market cap built on national security, all of that is being unfairly discounted. So we need to exploit the high beta nature of the stock, which is tied to these imminent binary events.
Okay, lay out the trade.
We propose a long position tied specifically to the operational milestones in early 2026. The trade would target call options expiring in the first quarter of 2026.
So you're betting on them hitting their targets.
We're betting on synchronous success. The thesis needs two things to happen at roughly the same time. First, management has to prove the Thompson Falls expansion is done in January, confirming that jump from 100 tons to 500 or 600.
And second,
that Fostung SK1300 resource report for tungsten has to come back strong, validating the whole diversification story.
so if both of those catalysts hit within weeks of each other,
Then the stock is going to experience a very sharp re-rating. It'll move quickly toward those analyst targets in the $10 to $12 range. It's an asymmetric bet, Success on execution could yield a multi-bagger return, completely overriding this short-term financial noise.
So what does this all mean for the long-term view? What's the summary here?
I think UAMY has successfully navigated the hardest phase, proving the concept, getting the capital, and securing those monumental long-term contracts. They've gone from an idea to an industrial execution story.
The narrative is solid.
The national security narrative is stronger than ever, but the next 12 months and the credibility of that $125 million 2026 revenue goal, it depends entirely on them overcoming the logistical risks and delivering that unprecedented six-fold physical ramp-up of the smelter. It is high risk, high reward.
And the final provocative thought for you to consider is this. When you look at this company's volatility, has the structural geopolitical necessity, the U.S. government's fundamental need to build an independent critical mineral supply chain outside of China and Russia, has that been fully priced in? Or is that long-term premium still waiting to materialize once the execution is proven?
A great question.
Thank you for joining us for this deep dive. We'll catch you next time.